SN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. It's Kerry, Lutz. And you know that we're always looking out for different ways to protect your income, different ways to earn a return in a zero interest rate environment. And I'm sure you're familiar with Jason Stevenson, investment executive over at Sprott Global. And he's been on the equity trading desk, Jason, and you really honed your understanding of domestic, foreign equity, commodity, and currency markets. And we're really thrilled to have you back on.
Thanks, Kerry. Great to be back.
Yeah. So you got something new here that I've never seen anything like before, but it is, well, I mean, in different industries, there's similar things, but reading this article on an outfit by the name of Input Capital, and they seem to have a business model that in alternative finance for farmers that could really grow and become something quite big.
Yeah, here at Sprott, we're always looking for different business models because the volatility in natural resources in general is something that creates a lot of stress on balance sheets if a business does not have the correct model. They don't have the ability to tolerate and sustain themselves through multiple cycles. One model that we've recognized as having that sustainability is the streaming model. A lot of people look at Silver Wheaton, Franco-Nevada, Royal Gold as that model, and Input Capital is applying that model to the Western Canadian farming industry.
Interesting. And I assume that they're just starting out there, but just explain how it works. I mean, obviously farmers are probably always strapped for cash. That's just the nature of the beast. And even if they're not, they're still looking for ways to level out their cash flow.
Absolutely. And so the business model really applies in the farming industry for working capital. And that's what Input Finance is. There's plenty of financing available for farmland in the form of mortgages or equipment through companies like John Deere. But really what Input is providing is working capital, which helps the farmer time when they sell their product, their harvest, and when they buy their inputs, so fertilizers and seeds. And just by providing capital and having capital on the balance sheet of these farmers, they can time their input purchases and their harvest sales to increase their profitability and their margins. So what Input does is provides upfront capital to the farmers, and then takes delivery of the harvest or a percentage of the farmer's harvest every year. So they put up money, and then they also provide a smaller amount to the farmer at the time of delivery. So it provides cash flow throughout the life of the contract, and also upfront capital to keep the farmer liquid and operating from a position of strength.
Yeah,
One business model that we've noticed, it consistently has high return on invested capital, and also in this case, Input is debt-free and has a rock-solid balance sheet.
Yeah, that's pretty cool.
So I believe it's about $30 million worth of revenue. So here's the risk in it, is that it's still a small company, about $200 million Canadian market cap, but they're growing, and they're growing very quickly. In 2010, we meaning Sprott, provided a preceding round of financing to them, and then from that time, there was basically zero streams. All they had was a good track record, or the management had a good track record. They've grown from 2012 to today up to 78 streaming contracts with 78 different farmers. So the diversification is something that you don't even see in the mining companies. mining companies may have a big portfolio of royalties or streams, but only some of them may pay. 100% of these streaming contracts pay every year based on their harvest. So the risks, obviously, are canola prices and the volatility in the canola prices, because input does take the price risk off the hand of the farmers on that percentage of their harvest. And also, like I said, this is a small company. So they have all the pressures of a small company that's growing quickly, but at the same time, something happens to the global canola market, and that's a huge risk to them.
It's a fascinating concept. So they must have to hedge themselves someplace to protect against a wipeout. Or
there's a couple different inbuilt hedges. One is that the farmers in Western Canada, they're partially covered by farmers insurance through the government, and also the ag business in general. When prices flare up, you have an onset of new production coming out of Western Canada. So prices don't stay high for long. We saw a bumper crop in 2012, which came as a result of a spike of canola prices. I think it was above $650 per ton. But as it's a bad farming season, basically what you lack in tonnage, you make up for in price. So there's almost an inherent hedge to the farmers and to input capital, because every farmer is very respondent and the market is very respondent to price changes, which is very different than most commodities.
Yeah, totally different. And yeah, I see what your point is there. So they're either going to, if they have a large crop and prices go down, then they're going to take more of the crop. And if they have a smaller crop, prices go up, they're going to take a smaller piece, and it works out.
These farmers have the ability to pivot on their farmland, which miners don't have. They have the ability to grow wheat on that land. They have the ability to grow soybeans. So if prices are too low, they just switch to another crop.
Right. Interesting. It's a really neat little company there. And what's the management structure look like, Jason?
So there's two gentlemen at the helm of this company that have a very good track record. They started the first farmland fund in Canada, focused on Western Canada, and they started that, I believe, 12 years ago. And about 2 years ago, they sold that fund to the Canadian pension system. So they exited that investment and started Input Capital. And so they have this track record and this network of farmers in Western Canada to work off. And basically that network has grown since starting Input and have increased their sales force and the manpower behind spreading the word about, an alternative financing for these farmers.
Really interesting that they found this little niche finance market, and you can see they could easily grow to cover most of Canada and the U.S. and overseas, because farmers, wherever you might be, have the same issues with cash flow shortages or inability to access adequate working capital, and really the fluctuation of prices and the inability to go to their local bank, which there are no local banks anymore, and get your crop loan. Basically, they could look to the government in the U.S., I guess, in Canada, but that's about it.
Yeah, they haven't found a market that is as conducive to this model as Western Canada yet, but that might be because of their own issues, their own scope of where they've been looking. But the one thing that the U.S. has that Canada doesn't have is a wider regional bank opportunity. So regional banks really take up most of the corn belt. So they are better served by the bank manager who may come from a farming family and understand the crop rotation and the needs of that individual farmer. Really, in Canada, there's 6 major banks, and they're all headquartered in Toronto, which is basically the Western Canadian farmers are kind of a flyover to the other coast. And so there's not a whole lot of interest in being 3,000 miles away and financing farmers who just need working capital and don't necessarily need the high dollar numbers that Toronto banking financial institutions need to kind of move the dial.
Right.
So there's the banking and financial institution structure really kind of makes the opportunity in Western Canada farming apparent. And I don't know that exists in the U.S. Corn Belt as much as it does in the Western Canadian farmland areas.
Yeah, well, I was thinking not so much for the real grain commodities because I see problems there, but perhaps soybeans, other higher margin crops where
absolutely.
where I think that their model really lessens the risk for farmers in terms of repayment and the price fluctuations. So I think maybe after they prove the system here, they'll be moving onward. But fascinating company. Just tell us, Jason, the stock symbol for the company.
It is INP on the Venture Stock Exchange.
INP on the TSX Venture. Interesting. We will definitely keep an eye on it. And hey, so Sprott, we all know, big in the resource sector. We all know what's happened to the resource sector recently. It ain't pretty, but obviously you guys are in it for the long term. What's your take on where we're at now in the cycle? Precious metals prices. What's your overall feeling in the office there?
Well, so in the last couple of weeks, we've seen a real rebound off the September lows. And I see that as coming at the hands of basically short covering and a short-term bounce off the pretty severe sell-off we saw between July and September. We saw a strengthening of the dollar as China's issues, financial issues, growth issues become apparent to the global economy. That hit a pinnacle in August, I believe, and kind of sustained itself through September as we saw clarity or more clarity from the Fed that they weren't going to increase interest rates. We saw a rebounding a selling off of the dollar, and that's really what's propelled gold, let's say, the last 1.5 to 2 weeks.
Mm-hmm.
I think that this is not something we should be reading too much into as precious metal investors. There's still the structural issues in terms of gold, which is that stronger dollar. I don't see that changing in the short term, but I do think that seasonal periods of strength going into the end of the year are probably still intact. So we might see some strength after we see this period of a resurgence to about 1,200 or just under 1,200. We see some softness or a flattening period going into the end of the year. And then we see some more strength going into a seasonally strong period in December. Now, I'm notoriously bad in terms of short-term calls.
Hey,
but
you and me both. We share that in common, Jason.
But
yes.
Again, that's kind of the way I see it, and we shouldn't be looking at this as the huge start to the next bull market, because I do think that bull market is going to be long and sustained. I just don't think we're there yet.
Yeah. So don't get too excited. Be a little bit encouraged, but don't think that happy days are here again in the resource sector. I mean, you see what's happening in oil there. More supply coming on stream here, Jason, and just a lot of uncertainty in the market. We got wars all over the place, and who knows when oil is going to start behaving properly with the market.
Right, and I think we talked last time I was on the show about oil and what it will take to see a recovery in the oil market. And I think this period of a sustained price below $60 is very good for bringing supply offline, punishing the over-leveraged producers, E&P companies, and also building back, I think, what are the more strategic acquisitions into the market. So the prudent companies that have room on their balance sheet for high return investments are licking their chops at this point with the idea that they have projects coming to them. And it may not be now, it might be in 3 months when we get clarity of what these lower prices will do to balance sheets of most of the industry. But the time is coming. And middle of next year, I think this industry looks very different than it does right now.
I think you're right. It's just a question of when. And that's the thing that you and I and the rest of us really don't know for sure. But resources essential to life as we know it, you can't not have them. So we better see this industry get back on its feet, or long term, we're going to have supply shortages, and we're going to have real serious problems in the economy and society if this sector doesn't right itself. And I'm not just talking precious metals, I'm talking commodities, energy, all of these things that seem to be in a very unstable, unsustainable period right now.
And I think one thing that I think you were alluding to also is civil unrest.
Oh, yeah.
Yeah, we can talk about economic effects and how here in the Western world we're going to have higher cost of goods or, slowing growth or anything like that. But really, we are in the best place to kind of sit back and watch civil unrest if these markets don't correct themselves.
Yep, absolutely. I couldn't agree with you more. And so it's inevitable one way or another, these markets will right themselves over time. You can argue that what's happening now is market breakdown, but the markets have to be fixed in the long run for society, regardless where on the planet it is, to function properly. And I think that's the long view. Short view, still a lot of pain left, perhaps, but maybe not that much, considering what's happened already. So, Jason, we want to find out more about you, want to connect with you. How do we do that?
So, best place to go to hear about Sprott's ongoing commentary about the natural resource market is sprottglobal.com. You can sign up for a complimentary newsletter called Sprott's Thoughts. It is, again, complimentary. You can also email me if you want more information about our services at jstevens@Sprott, S-P-R-O-T-T, global.com.
Excellent. And as always, you will find a link to Jason in the show notes to this interview on financialsurvivalnetwork.com. You really should visit the site. Our webmaster, Stefan, spends hours every day finding articles just like the type we're talking about here, about resources, about resource investing and avoiding the pitfalls, things that you need to know, because the world's very, very dangerous, tricky place right now, and fortunes will be made and lost. And the more you know, the easier it will be to protect your fortune. And also stay tuned on November 4th, 2015 at 9 p.m. Eastern time. We will have a webinar with several acknowledged financial experts entitled How to Pay Off Your Mortgage in 5 to 7 Years Without Really Trying. And I recommend that if you have a mortgage, you check that out. You will get information on it within the next several days if you're on the mailing list. So make sure you sign up for our newsletter and all the reports on financialsurvivalnetwork.com. Jason, thank you so much for coming on. I always enjoy speaking with you. Always got new and different ideas, and we will talk with you again soon.
Thanks, Kerry. Pleasure to be with you.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.